How's everyone doing this morning? We're looking for a fun debate up here on permissioned blockchains versus public blockchains. And I think when we were prepping a few days ago, we were wondering why it's not permissioned versus public versus private. So maybe we'll dive into that. As a quick introduction, my name is Prashant Kher. I'm a senior manager and our digital asset strategy and transactions leader at Ernst & Young. Been working in the digital asset space for quite some time, primarily with a lot of large TradFi firms, banks, asset managers exploring their use cases, their strategy around blockchain technology, digital assets, and cryptocurrency. And we've also supported a number of the recent transactions and deals in this space as well. I'm joined here by my wonderful panelists. Maybe Annelise, let's start off with you with a quick introduction.
Sure. Thanks for having me. Excited to be here. I'm Annelise Osborne. I'm Chief Business Officer of Kadena. Kadena is a layer 1 proof-of-work blockchain. We've been around for about 5 years. We are public with permissioning aspects. I also have a book out there called From Hoodies to Suits, if you have friends that are interested in institutional blockchain, just to understand what it is.
Hi, my name is Jesse Bornstein. I'm the Chief Commercial Officer of SonarX. SonarX is a blockchain data infrastructure company where we grab blockchain data, we index it, we cure it, we clean it, and then we unify it so it's very, very easy to use. And so we're solving kind of the big data challenges that blockchains represent. We've got over 100 blockchains covered today, and we're keeping up with the industry as it keeps evolving.
Hello, everybody. I'm Eric. I'm one of the co-founders at Digital Asset. Digital Asset is the company behind the Canton network. It's the only public permissionless blockchain with privacy and smart contracts.
Good morning, everyone. Todd, McDonald, co-founder at R3. We've been tokenizing assets for about 10 years now. I think before they called it that. We have a blockchain called Kher, which is designed for financial institutions specifically. And we've been active in central bank digital currency and regulated digital assets and focusing on how to increase the reach and liquidity of those across Kher networks and other networks. Excellent.
Maybe to get things started, Todd will start and we'll work our way down. So why don't you start off with your views on what do you feel the core benefits and value propositions are of a permissioned versus a public blockchain, and potentially how has your thoughts and your ideas evolved over the past few years?
Okay, so I guess we're going to try and figure out how contentious we want to be. I mean, I hate to disappoint folks, but we probably are going to agree more than not.
Sadly.
Sadly. So, it's kind of odd to me, the permissioned versus public kind of aspect here. So we've always been focused on what are the requirements, and we've thought about things from a capital markets type context, where there's all different types of markets. There's different needs, there's different potential participants in permissioning. You look across the landscape of all different types of markets, OTC, listed, and retail comes in many shapes and sizes. What we feel, and I think where the industry is heading, is that you need to be focused on the use case itself. We obviously have been very involved in central bank digital currencies, and here in the US that is now truly a 4-letter word. It's going to be very difficult in the next 5 to 10 years for central banks to be deploying technology that is public permissionless. Maybe you can debate that from the merits on the technology, but I'd say from a policy perspective, that's just the facts. Outside of that, everything else is kind of a jump ball across the different spectrum of say, public versus private and, say, different types of permissioning. I think where we're going to agree is that most of these use cases need some level of privacy, or I think transparency, control transparency, and a lot of these use cases do need, whether it's from a regulatory perspective, permissioning of those that can participate in the network, but also just not only from a regulatory perspective, there is I think, a desire for those to know the kind of parties that they're trading with.
Excellent. Eric, maybe over to you.
Yeah, sure. I kind of have always rejected this concept of this being a debate. I consider it a false dichotomy. And the easiest way for me to try to make this point is, what's the most successful public permissionless network in the world? I'll put you on the spot, Todd.
What's the most?
Successful public permissionless network in the world.
The internet?
Yeah, I'd love that answer.
Wow.
That's the answer, right? Like,
Well, we should take this act on the road, Eric.
some people, in the crowd might be maxis. They might have gone Bitcoin, or what I like to call the meth heads, the EVM fanboys. They might have said Ethereum, but I mean, the internet dwarfs those things. And the thing that is, I think, a really important defining characteristic of the success of the internet is that it's a totally public permissionless network, but your app is permissioned however you see fit. You can run a totally permissionless app, you could run the CIA, and anybody can join. And just because I have a browser doesn't mean I get to see everybody's bank account at chase.com. And that heterogeneity of data permissions, access permissions, what you can see and can't do, that's the hallmark of having one network that captures all of its network effects and has a flywheel around network effects. So I completely agree with Todd that a central bank is never going to go to the public networks that people think of when they think of those, because it means forfeiting governance of what you do, forfeiting the data permissioning of what you do, and that model doesn't work for them. So they've been pushed into private deployments. But when there are public networks that allow you to permission your data, control your assets, but be part of a bigger ecosystem, that'll be the long-term solution.
All right, Jesse.
Yeah, I have a much more simplistic view. I kind of generally view this as if your use case needs to optimize for entitlements, obviously permission blockchain. But if it's to optimize for access, I think it's public blockchains.
Annelise?
I use a very similar explanation to Eric's when it's about private and public. Like if you think about the intranet, before companies were not comfortable using the intranet, and so they went to the intranet, and that was the first step. But obviously there's a lot of benefits for the intranet. But I also feel like from an institutional perspective, which we'll get into, I think the gold standard really was R3 and Canton early on, with the fact that everything was private from a regulatory perspective, and also from a mental perspective. How do we build and grow with a technology we're not as familiar with? But I do think there's a lot of benefits from the public side as well. Now, the public can add permissioning also. Obviously, I think for regulation and for securities, there needs to be permissioning. You need to have whitelists. You need to have digital identity. But I think there's a lot of benefits if you look at, for example, tokenized funds, right? If you look at the funds are going to all sorts of different ecosystems, even in the public space. Now, digital currency is a little bit different. If you think about kind of JP Morgan coin, for example, right? Or CBDCs that Todd was referring to. I think there's a lot of, it depends on the use case, what makes sense, but I think both public and private can have permissioning.
Yeah, sorry, I just want to add one. We just had Securitize on stage right before. They permission all the assets that they issue. It doesn't matter that they're on permissionless networks. So like even a lot of the household assets that people like to look at and point to and say, look at the adoption of these chains, they're permissioned on permissionless networks. So the question is just what level of permissioning do you have? But otherwise, I think eventually everything migrates into the public ecosystem, because that's where you get the benefits that we were just listening to about, composability, interoperability with other things, the flywheel of innovation that takes place around you. If you're in your own silo, you're really stuck. And if you only did that for permissions, then I think you really missed the move.
I think all great points, and appreciate the introductions and the thoughts. Why don't we start off with, for financial institutions specifically, as they're embarking on their journeys, as they're thinking through, understand the trade-offs, the differences between permissioned versus public, understanding also the confluence of the two of them. As they're thinking through, how do you think organizations should think about weighing things like privacy, ownership of data, risk profiles as they look through their efforts? Maybe Todd, we'll start with you.
So once again, if you're a financial institution, it depends on what you're looking to do. I believe that we're going to see a convergence here, but I think it's going to obviously, well, I shouldn't say obviously, it'll play out differently than people are expecting it to right now and at a different timeline. When we speak to financial institutions, they have a keen interest to participate in what's going on in DeFi, or probably better said, sort of the on-chain markets. But they're trying to figure out how to do that and why they would do it. I think that it's also quite interesting where these on-chain participants are looking at TradFi to try and figure out how either they can access those markets or bring them on-chain. I think in the near term, you're probably not going to see a lot of commingling because you kind of get the worst of both worlds if that happens. Where if you're a financial institution, you're looking at participating in wholesale or interbank type of a market. There's less of a need to jump into public networks. But there is a lot going on within on-chain, the on-chain ecosystem that I think that these institutions really have to get involved in. And I think interestingly, there's product that can be brought on-chain that could be very, very impactful. But it has to be done in the right way because, as Eric was saying, DeFi has its trade-offs. Everything in life has trade-offs. This is the one thing I've learned in the 10 years of running a technology company, right? So what are the trade-offs that you can be okay with by participating on-chain? And also, if you're on-chain, you have to create these products that are composable and that can be put into DeFi strategies, can be looped, can be used in a way that borders on permissionless and could go beyond the borders of maybe what you can do today. So they're still trying to figure that out, but there's more and more interest in that. I think importantly, right now the on-chain economy is big enough for financial institutions to pay attention to and to try and bring product into. And I think you're going to see more and more of that over the next few years.
Great points. Eric, over to you.
Yeah, I don't know if I disagree with something you said or maybe I misunderstood it, but we're very much at the intersection of crypto native and TradFi, and think about what stablecoins are. Stablecoins have really broad public appeal at this point. I think actually significantly undersized. And part of the reason that they're undersized is that they don't play well with capital markets, even though they're entirely dependent upon capital markets. So what's backing your dollar? Deposits, treasuries, repo, money market funds, but they move at a Monday to Friday business hour time, and stablecoins are a 24/7 business. So that gap between the two is something that we're working on to be able to do things like 24/7 repo markets to create or redeem stablecoins, or to be able to instantly provide liquidity between money market funds and stablecoins so you could sweep out of a stable into yield and vice versa. And this is being done with balance sheet today, so when you see someone like a BIDL instantly swap into USDC, that's just Circle extending their balance sheet to you. It's not capital markets, that's actually risk. And when you can tie and fix capital markets problems that the TradFi institutions are the best at, on-chain into these crypto native products, you can get the best of both worlds. So I don't know if I misunderstood you before, but to be able to 24/7 create or redeem a stable with the delivery of a tokenized treasury is a pretty low risk, high quality.
Yeah, I guess, but you're still trying to bring that to the on-chain world as opposed to bringing these two things together. I think that's
they'll be composed together. So maybe I misunderstood. So on Canton, you'll have a subnet of treasuries, you'll have a main net of stablecoins, we'll have a separate subnet of repo, we'll compose all those things together, mint stablecoins in an on leg with the delivery of a tokenized treasury.
You're trying to extend balance sheets into this world, right?
I'm just saying it's the confluence of all those things together.
Unfortunately, we're sort of agreeing with each other. I hate to break it to you.
Like I said, I may have misunderstood you.
We need more debate. All right, Jesse.
Yeah, so from our view, a lot of the context of most of the conversation is around writing to blockchains, right? And we talk about data, and you're talking about the transactions you guys are facilitating with your networks. What a lot of people don't really think about is the reading of blockchain data, which is actually much more complicated than I think people realize until they actually dig in. And one of the problems is that blockchain data is extremely raw, it's unreadable, and every smart contract you deal with and every network you deal with has its own nuances and its own complexities. And then on top of all that, blockchain data is immense. As an example, we're sitting on a petabyte of data, and pretty much every blockchain doubles in size each year, right? And so when we think about data, the premise is if you're entitled, you're enabled, and you have access to that data, that's great. But now how are you going to read it and how are you going to actually use it? And this comes up a lot once you have a more serious use case and the auditors are starting to look at it, the custody providers, the KYT providers. Typically that's in the context of a public blockchain. But now, as you're seeing more interoperability, and Canton has its subnets, and a lot of like Avalanche has subnets, this now creates more complexity because now you have more blockchains to deal with, right? And so that's the problem that we're very, very heavily focused on. As this space is growing, we just see this problem getting bigger and much more complex. And so whenever we talk to new entrants into the blockchain space in whole, a lot of people think, okay, this will be easy. I'll just spin up a node and now I have all the data of the blockchain. But in reality, winds up, they realize, okay, I need to dedicate a team of like 30 to 40 people to just do this, and there's no way I'm ever going to do it. It's going to take me years and cost millions of dollars, right? And so those are the types of problems we're really focused on, and because every day there's a new blockchain that's coming out, right? And we don't know where all the activity is going to happen, where it's all going to take place, and so everybody still wants flexibility. And so that's really been our focus and a lot of the conversations we have with the bigger financial institutions.
So I think we start on privacy and identity. Is that right? I'm going to tie it in. So I think there's, look at Europe, right? Any financial institution has to follow regulations, and there's big privacy protections out of Europe for financial institutions. I also think, like, past that over, I fully believe that Todd was alluding to about kind of DeFi and TradFi merging. I think there's a lot of DeFi that is very similar to TradFi today. It just is, there's privacy protections that aren't around that traditional finance will need, but I do think that they will come closer and merge. A lot of that has to do with which identity, right? I think identity is one of the big challenges before public takes off. So Kadena's kind of getting into the space now in the public. I started in the space in 2018 and was way too early, because at that time it was really private for financial institutions. But now people are trying to figure out how can we use a public chain with permissioning, including different identity in it for those benefits. But I do think that's the biggest challenge right now, is figuring out digital identity. If you look at, Larry Fink just came out talking about how things should be on public chains, but we need to solve for identity. So I think there's a lot of benefits. Franklin Templeton as well is talking about how funds should be on chain, from the faster, cheaper, more secure. And also think about it, blockchain is trying to get rid of intermediaries with the idea before that crypto launched. And so financial institutions have to pay attention and kind of adjust it to their business line so they're not left out.
I think it's a great point on the privacy and identity part, right? If you're having organizations interact on public chains, will organizations want other organizations knowing what they're doing? So how do you solve for that? So as we jump on maybe to the next topic, Todd, we'll start with you again. As you think about use cases for financial services and different applications, whether it's funds or stable coins or CBDCs or cash or security assurances, how do you think about different trade-offs there when you're looking at permission versus public versus privacy, interoperability, things like that?
Sure. So if you look at, maybe we were talking about stablecoins before, so every bank out there is trying to understand, should they be involved in a tokenized deposit or a stablecoin use case? How would that work? There's different ways to approach that, and I think if you're, say, large enough, like a JP Morgan, you can create your own coin that's in effect tying together your internal networks, and that could be successful. For most other financial institutions, there's a different calculus there. So trying to understand how they could, what is the point of issuing that on a chain, and what it would be used for? Is that for your own customers? Is it to service your existing networks, or are you trying to reach outside of your existing network? On the flip side, obviously, there's the asset management community is incredibly interested in trying to figure out different modes of distribution for their product. And it's great that there's a continued experimentation with that. Honestly, I don't really think folks have figured that out yet. And I think it goes back to the point I was trying to make before, is that if you're issuing an asset onto a public network to reach an institutional client base, they're not there yet. So don't expect them to be. If you're going to try and issue something and wait for a Vanguard or on the other side of the trade, you're going to wait a long time. But there is a lot going on natively on chain, and there are more and more, I think, crypto native sort of asset managers or family offices that are participating in that world that you can potentially tailor products to. And then on the flip side, I think there's still a ton of use cases in the traditional finance world. You know, as Eric was saying before, there's tons of problems to fix. They usually are a slow burn, and that's why at R3 we fairly early on started to sell into and service existing market infrastructure. So that's not just the central banks, but CSDs and other FMIs. And that's where you see them utilizing this technology within their existing networks, which are private and permissioned networks, but being able to launch these networks where they can issue digital securities within their ecosystem, but bootstrap it with their existing participants and networks. So SDX and Euroclear and others are examples of that. So I think it's just you have to really focus on what you're trying to achieve.
Yeah, I mean, we think that the singular technological advancement of a blockchain within this context is composability. And so when you start to think about the use cases, your example about JP Morgan, it's great to start with something you can solve yourself or within your existing silo, but to really get return on the investment, you need to start to think about what are the other applications that you'll be composed into, especially on the dollar side, especially when you're thinking about money. And so it's important to have a path to composition, and composition meaning as if you're native L1 DeFi. There's this word interoperability being thrown around a lot. I personally am quite allergic to it. It's no better than messaging and reconciliation, what we have already today. Private blockchain to private blockchain, public blockchain to public blockchain, public to private, public to its L2. All those things are just messages and reconciliation with all sorts of risks that come into those transactions may not complete. You might have one-sided transactions. It's the same problems that we deal with in finance today. And the true novel innovation is atomic transactional composability. That happens within a singular network. No one can solve it across networks. So you need to be, when you're thinking about your use case, you need to look at what are the other things in the network. I'm not making an argument for mine. I'm saying if you're going into this network, what are the other things there where my use case is additive and I can compose into something else, or I benefit from something that's already there. And a lot of people tend to overthink this. I think really we've never had composability with money in any of our systems today. Every equity settles Fed and DTC. Every bond settles the CSD and the central bank. So we've not had composability in money ever in capital markets. So just the concept of flowing cash through your bond payments or a true DVP without operational risk. It can start with just the cash side. You don't need to start thinking about financing or leverage or repo markets. And so it's really critical to get that first use case solved, to get some value out of it, but not to get complacent and to start moving into the composition opportunities.
Yeah, I very much agree with what you're calling composability, and I don't want to set off your allergy to interoperability, but in our view, it's obviously the composability leads to innovation and things we haven't even dreamed up, and we see some of this in DeFi, and I have no doubt some of those primitives will carry over. I think, though, the way we think about it is flexibility, because, as I was saying earlier, like at this point in time, launching a new blockchain has gotten very cheap, and the speed to take it to market has also gotten much faster, which means if you're launching a product, you care more about where the liquidity is going to be and what's going to be better for the business around that product, right? And so having inherent flexibility in being able to be interoperable or composable onto a different blockchain or into a different decentralized application is going to be very, very important. And so I think of interoperability more in terms of flexibility and being nimble to be on any blockchain or interactive with any smart contract.
I think every one of us in this room has this vision of where we can see the applications of blockchain and what it can actually do. And we're not there yet. I think we also have to look kind of 2, 5, and 10 years in the future, right? Where do we want to be? Where do we aspire to grow to? I think one of the big steps there is infrastructure, and it's the connectivity, and it's plugging in institutional rails into blockchain and having them kind of work together. It's recognizing, like, think if you have any debt instrument, if it was more or less paying out dividends, conditional statements, what have you. There's so much that we could build for a faster, cheaper, more secure. We're just trying to figure out all of these iterations now. So I agree with the panel and kind of what we can do and where we can go. Everything needs a use case. So with the faster, cheaper, more secure, where we're going to be in the future, what makes sense? So currency obviously has shown things. I think currency or payments, right? Payments can be faster. Funds and debt, I think they're the first steps. I know that stocks are coming on chain as well, and there was a panel that unfortunately I missed yesterday. I also think part of this is learning from the crypto market in the last 15 years, things that they've worked through. And there's more going on in the crypto market right now than the institutional market outside of the kind of tokenized treasuries, right? And so how can we, I think part of that is trying to bring more people into the ecosystem. Also think about the next generation and where the wealth's going to be. It's in Millennial and Gen Z. So they're going to be the ones, and they're much more crypto native. So I also think that from a asset manager perspective, and even from banks, they have to think about who their next customers are.
So we covered a bunch of topics on use cases and applications. We talked about interoperability. Maybe Todd, over to you. Beyond interoperability, what are some other technical advancements or needs required to really bring more assets on chain and drive more adoption amongst financial institutions?
I feel like the teacher's pet. You keep starting with me. I'm blushing. Well, maybe before I answer that question, maybe to disagree or push on some of the stuff that was just said before. So I guess, I guess, Jesse, maybe you're right. It's the marginal cost of starting a new blockchain is trending to zero. But, it's kind of like content and music today, right? So, every jerk with a guitar or whatever in their bedroom can create a new song and put it on SoundCloud or whatever. Doesn't mean that you're going to listen to it. So there's going to be power laws everywhere. So it means that it's going to be a handful of these blockchain networks that would win. And then Eric, to take your point of everything's about composability, then it's kind of like a race to being the one network to rule them all, which I think is what you guys are trying to do with Canton. But that's like that's a moonshot, really. So it's tough. So I think composability is really important, but interop still is very, very crucial and critical, because over the next handful of years, there's not going to be a single winner. I mean, when we were starting R3, Ethereum was just the yellow paper and sort of a concept, and it has been wildly successful for what it was trying to do back then, and everyone hates it now. Right, so now it's like it's the lowest ebb from the vibes perspective. So this is a really hard game. Ethereum as an ecosystem has succeeded in every way they set out to succeed, and it may also die. Right, so this is a hard game. So interoperability is incredibly important for two big reasons. Number one, if you want to do stuff today, you're going to need to face interoperability and try to understand how it works. And two, we sell into financial institutions all the time, and they're trying to figure out where to place their bets, and they hedge quite a bit. So interoperability is allow for that. And I think there's ways you can do it which are not about necessarily bridging assets, which is fraught with risk, but where you can have concepts of interop or allowing for delivery versus payment scenarios that can unlock use cases today. I mean, you talk about things like repo. What we found is that a lot of times if there's an asset network, they don't want to have cash on the same network for many different reasons. So having them on two separate networks but still allowing for something like intraday repo is really, really powerful and important.
Yeah, sure. I think the stuff that's really missing. Look, I'll say something nice. There's only two companies for a decade that have cared about a threshold issue, privacy, and it's ours. I don't know how that happened. I don't know why people put this on the back burner. You go back to, I was in the chat room, in the old Slack, not Slack, but the old chats with Satoshi and Zuko. They're saying that Bitcoin will not work without privacy, but we got to push, we got to go. And then somewhere in the middle of our journey, privacy got thrown out, and public transparency became the reason to use a blockchain.
That's because it's super hard.
Yeah, it is very hard, but your question was about how do we get the next level of adoption. I think we have a tendency, and I've already said it earlier, to think that stablecoins have radical product market fit, but really only within the casino where people are willing to move stuff around transparently because the utility is so overwhelming. You don't see stablecoins being used for payroll. You don't see them being used for B2B payments. You don't see them being used for sensitive information that would take place, because just imagine if you make some sensitive bit of information part of a permanent public record. It is a threshold issue. It's not something to just get comfortable with. People will not adopt public chains without the right data permissioning schemes. There are the secondary ones as well about control. So people don't fully understand this or realize this until you get into the classification of an asset and you dig into the bowels of the Basel rules and securitize what they're issuing. Is the on-chain record legally binding, or is the TA's record legally binding? They all stem from the same problem, that when you use one of these public chains with pools of validators, you've forfeited control of your asset to some pseudonymous group of non-deterministic actors. Again, something that we've not built into our design for a decade. And those are, again, threshold issues. When the regulator says, who controls the treasury, only one party can answer, or at least a very well understood known group of people can answer that question, or you don't really have what fits within our existing legal system and case law. So there are two major threshold issues that have to do with data permissioning and control of your assets that just signing a message on another chain does not solve for. So I think that we've hit more or less the ceiling of what we'll see for RWA adoption in the public networks in the current form that you see them today. I mean, it'll grow plus or minus 50 or 100%, but let's be honest, those numbers are paltry today. I mean, we do about 200 billion a day of repo, and that's a meaningless number, and we're 100, 200x all the other public networks combined. So if you're being honest about what's going on in the public blockchain space today, they have not been able to capture these assets because they are lacking the features necessary to actually make it possible. And it's not easy to launch one of these things, because what is getting launched quickly are just copycats of the things that don't already work. So it is a material investment to think about ground-up design to solve these threshold issues. Someone that did a great job of this is Solana, but they were focused on fast and cheap. Everyone thought you could kind of bolt on fast and cheap or modify your consensus algorithm, but they holistically built something different, and they actually delivered. So these other issues are still completely unsolved outside of a few of us, but it doesn't get the appreciation that it deserves.
Yeah, it sounds like they've solved these problems. So like we're there from a technological standpoint. I just think it's more behavioral actually at this point, and we can argue the merits of public blockchains and will it be meaningful or not. But I think there's extremely strong signal when the largest asset manager in the world, I know we've thrown around BIDL a million times in this conference, but like when they come to town and they actually put something on a public blockchain, it's pretty like eye-opening, right? And it kind of opens the door for anybody else in any bank, asset manager, any financial service company to say, okay, like I should be looking at this, I should be experimenting. I think one advantage that public blockchains have is, and this is also a function of the space, but they can bring a lot more attention to what's happening, because by their nature, they're not so focused on privacy, right? And by your guys' nature, you can't boast your chest so much about who you're doing business with and the kind of activity that's going on. And I think that in some ways hamstrings you. You probably don't care because you're still getting stuff done. But I think when you then have a big player come in and actually take even public blockchains seriously, I do think it's eye-opening. And then back to the interoperability and composability point, then everyone else thinks like, well, what can I do here? And then you start to get a lot more intellectual capital looking at this stuff. And so I think from a technological standpoint, there'll be gains just from the composability. But I think most of the infra is there, or you wouldn't be doing $200 million a day of repo trading, right? Like it wouldn't be trusted. So back to what we do, we're focused on the readability, right? And so we still think there's a lot of work to be done on readability, and especially readability with low latency. That's still a major problem, and it matters more in certain use cases. But anyway, that's where we're focused.
So I represent public blockchain. I'm a firm believer in the world will become more public, but I also think that there's different use cases for different things. So I think there are use cases for private, I think there's permissioned, I think there's public. I also think there's, part of this conversation is what is decentralized and centralized, right? Public is obviously more centralized, and decentralized, private is more centralized and public is more decentralized. So I think that is something to think about well. And I'll take the opposite side of stablecoins. I believe, well, the next thing actually for adoption, I think we need more of a Web 2 experience for Web 3, right? We need a better UI UX. We need people not to talk about blockchain, just to have an opportunity where the institutions have to either make money or save money, right? Otherwise, it doesn't make sense to do it. And so it's kind of back office or front office. So we have to find out real use cases. And again, for me, out 2, 5, and 10 years, there's kind of different steps along the way. But I do believe in like PayPal USD, right? If I don't know that I'm using a stablecoin, but I can transact it right away, like that can increase the velocity of money. If I'm going to save fees because I'm sending it to a different country, I don't have to worry about currency conversions. I can decrease the number of fees and middleman in place. So I definitely see, from a payments perspective, opportunities within the stablecoin ecosystem.
I think all great points, and really liked your point around the, investors or users may not really necessarily care what the underlying technology is. I remember being in a room with a colleague with a large asset manager, and my colleague started talking about DVP, and we were talking to a head of a business, and he said, cut the tech porn, what's the benefit to the investor? And so in reality, what is the use case you're trying to solve? What is the value you're trying to drive? So we've got about 45 seconds for this last question per person. So we'll do a bit of a lightning round, and Annelise, we'll start with you. But over the next 3 to 5 years, where do you see all this going? Do you think we'll still be in a world where there'll be private chains, permissioned ecosystems? Will we actually see a full public world? What will we see with assets moving on chain?
As I said, I think that there's really an opportunity for everyone. I don't think there's one straight winner. If you think about kind of Bitcoin came out, was amazing innovation. Ethereum came out, it was the next level. There's different blockchains for different things as well. One might be faster for gaming or NFTs or meme coins, and one might be more DeFi centralized. And then there's obviously opportunities from a private perspective, and an institution wants to do X, Y, Z. But I do think the ecosystem and the connectivity and the opportunity for on-ramps and off-ramps really makes a difference. So I do think there will be multiple chains. I don't know that there will be 1,000 chains. I don't think that necessarily makes sense. But again, different use cases. But I'm excited this year. I'm very excited about the sentiment that we have, both from financial institutions and from builders. So I think we'll see a lot next time when we sit down about innovations that we've come through, not just in regulation and legislation, but also just in building, and more in the United States, which is fantastic.
Yeah, my view is kind of to the point Todd made earlier about getting towards that singularity, if you will. Like, I do see that's where we're going, where whether it's retail or financial institution, they don't know that they're dealing with a blockchain, but they happen to be dealing with many blockchains under the surface because each blockchain is good at certain things. And there's so much like orchestration, interoperability, composability, infrastructure that's built around where it doesn't really matter, right? And you know that you're going to launch a product and you're going to get the entitlements and the privacy you need for that use case, and it necessarily doesn't really matter. And like you heard Michael earlier on stage at Securitize, he literally said like chain agnostic, digital asset agnostic, right? Like, and I think that's how most people will think because they need to maintain the flexibility.
Commoditization almost by default means consolidation as well, so definitely a major reduction in the number of options in the market. I think the most important thing is in 3 to 5 years, maybe private chains won't be completely dead, but at least them being a destination as like your final stop will be dead as a concept. Totally appropriate place to start, but I don't think it's the appropriate place to stay. And we'll see, consolidation and this mentality shift that at some point in horizon, you must be in a public network.
So I guess I'm an OTC guy at heart. I was FX trader for many years, and I think that we're going to see an evolution that's more like that than like everyone having to jump onto a handful of destinations. So I think it's going to be more network and networks in the next couple of years. I think the really important thing is how do we on-ramp more participants, more institutions, and I think, interestingly, more networks. So as Eric said, maybe you start with a private network, or maybe you have an existing network that you want to light up and bring into a wider ecosystem. I think that's going to be really, really important, and that's the work that we all have to be doing over the next few years.
All right, perfect timing, about 30 seconds left. So appreciate all the insights from the panelists. We had some good discussion, good debate. Thank you all for having us, and we'll see you around.